Depreciation is one of the biggest advantages that the government gives us. And this comes through real estate. It comes through other private investments. If you're invested in oil and gas, there's a lot of write-offs that you have with that. Business equipment through Section 179. Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larsen. All right, today we are going to be talking about Chapter 3 of our new ebook, How to Become Financially Independent by 40. And you can get your copy of this or get on the list before it's released at nextlevelincome.com/financial freedom book. Again, that's nextlevelincome.com/financial freedom book to get your copy. And the exciting thing is, this is not a hard copy book that you just read. This is interactive. So wherever you are in your financial journey, you're going to have a step-by-step approach for what to do next. And once you're there, you can schedule a strategy session with our team, a free strategy session, to learn how to get the right resources for you at your point in your journey. Now, I got some bad news. Today, we're going to be talking about taxes, and we're going to be talking about your entity structures. So, most of us don't love to pay taxes, and attorneys are involved with entity structures. So maybe not the most fun topics, definitely not the sexiest topic. But what I will say is it is probably the most important topic in this book. If you've already built a high-income career, a high-income business where you're generating a lot of capital, do you have the proper structure in place for your taxes and your entities to protect you from some of those insidious little silent killers of wealth? Taxes eating away at your wealth, potential lawsuits, even death or disability in your life if you're the primary breadwinner. These are things that are really important. And what I can tell you is from my experience, losing my father at 5, watching my mother pass away, my sister pass away without life insurance, watching my stepfather go into long-term care without long-term care coverage. These are very expensive mistakes to make for your family. So my goal today is to help inspire you to set up the right tax strategy and the right entity and insurance structures so you can avoid some of the challenges that our family faced. But I want to start with a story. 10 years ago, I sat down with my accountant, and we're good friends, and he pours me a bourbon and he sets it on the table. We were meeting late in the day, at the end of the day. And I'm thinking, wait a minute, we're not celebrating anything here. And in a confused state, he probably looked at my expression and he looked at me and said, Chris, what's the number you're expecting me to tell you today? And the number he was talking about was how much I had to pay in taxes from the prior year, the check I had to write. Now, I was earning, several $100,000 a year, so I was already paying a lot in taxes every month out of my paycheck, every quarter. But we had some sales of some properties, we had some other investments pay off, and I had to write another really large check, about 50% of what I'd already paid in. So we had a big, hefty 6-figure tax bill this year. And I will tell you that bourbon didn't help very much. I went out of that meeting. I was kind of sick to my stomach. And I said, there's got to be a better way. And unfortunately, as a W-2 earner, there's not a lot you can do in terms of structuring your income, but we have great partners here at Taxes Saved that can help you even if you are a W-2 earner. So feel free to email me, chris@nextlevelincome.com, and just put Taxes Saved in the subject line. I can make a connection. You can do a free strategy session with them to learn how you can minimize your tax bill or optimize your taxes, even if you are a W-2 earner. Now, coming out of that meeting, my wife and I sat down, we looked at our income, we looked at our business structures, and we spent the next couple of years restructuring not only our investments, but also our income to optimize for taxes. Because when it comes to money, it's not what you make, it's what you keep. And if you live in a high income state, you may be paying 50% or even more of every incremental tax dollar that you make. And a lot of us have viewed this just as a necessary evil. We say, okay, our CPA gives us our tax bill at the end of the year, or even says, hey, you got a refund, which I hate getting refunds because that means I gave my money to the government basically as a tax-free loan where it could have been doing more work, earning more money somewhere else. So one thing to remember is taxes compound negatively. The more you pay in taxes, that compounds. That's money you're not able to compound yourself. So we're going to talk about keeping more of what you earn today and ultimately protecting what you build over time. And consider this. When it comes to investments, the same thing is true. If you're earning 15% in an investment, but you're paying incremental taxes on that, giving away, say, 50% of what you earn, but you have another investor that's only earning, say, 12%, but it's tax efficient, say, in a real estate investment with depreciation, or another potential investment that is tax-free for a period of time. For instance, our life insurance earns dividends in a tax-free fashion. That investor that's earning 12% is going to come out potentially way ahead of that investor that's earning 15%, but that's paying a lot of taxes. And again, it's important to remember that taxes compound negatively, just like your returns compound positively. And I want you to ask yourself this: do you have a tax strategy? Are you looking proactively at the next year? Are you working with your CPA or your accountant and saying, how can I optimize my income and investments to minimize my taxes? Or are you just giving your CPA your payment stubs, your investment information, and file your taxes once a year and then react to what's already happened? If you're doing that, there's not a lot you can do to go back and change your situation. And the wealthy do the opposite of this. They plan proactively. They structure their income intentionally, and they align their investments with tax advantages so that at the end of the day, all of their income and investments optimize their overall returns. So most people are reactive. They're going to file their returns. They're going to pay what's owed. And they're going to move on. Our wealth builders design income streams. They control the timing, and they use the proper legal structures to not only minimize their taxes today, but minimize their lifetime burden. And I want you to start thinking about from being compliant to being strategic in what you do. And we're not talking about evading tax. We're not talking about breaking the rules or evading tax. We're talking about using the IRS tax code as a rule book. I want you to think about that. If you look at the cover of my book, it's got Monopoly pieces on it. And if you've ever played Monopoly, there's some rules involved. And whatever the game is, whether it's Monopoly or if you like to play cards like poker, you're not going to sit down at the table and expect to be as successful if you don't know the rules of the game. And that's how the tax game works. The IRS has given you a very lengthy rule book. I will not say I've read the entire tax code. That's why I hire CPAs that understand this. But I don't say, hey, what do I owe? I say, hey, what do the rules say that I can do to optimize my taxes? And this is really important because the IRS and the government, now they're not perfect by any stretch of the imagination, but they want to incentivize us as citizens to put our money into productive places. That's why there's different rules for capital gains. As business owners, we get rules for investing in equipment because it's going to grow our business. And eventually it's going to, as business owners, we want it to create more money, which means the government is going to get more tax. So they want to incentivize you to do that. And if you remember that moment on the debate stage with Donald Trump and Hillary Clinton, which was also about 10 years ago, Hillary points out that Donald Trump pays almost no tax. And his retort was, that's because I'm smart. That's because I follow the rules. And he said to Hillary Clinton, I'm paraphrasing, if you don't like it, change the rules. I just learned the rules. And I read another thing on social media here in the past week where a billionaire said, I'm paying hundreds of millions of dollars in taxes through my businesses, through my income tax every year. And I have structured my business. This gentleman was in his 70s, I believe, older gentleman. He said, I've spent 40 years structuring my businesses and income to optimize for taxes. My question to you is, are you doing the same thing? So at the end of the chapter here, you can go online and get a copy of the book in the show notes, but you can also just email me, chris@nextlevelincome.com, put taxes saved in the subject line, and we'll get you resources to learn how you can optimize your taxes as well. Now let's shift a little bit and talk about structures. We're going to talk about, first off, income. Are you a W 2 employee? If you are, you're going to have the highest tax exposure and the least flexibility, but that doesn't mean you don't have any options. But I want you to be open minded when it comes to your tax situation. You can have a 1099 or a solo proprietor. So if you're out there, if you're a consultant, you may be getting some 1099 income. There's a lot of things you can do with your accountant to run expenses, your everyday business expenses, like your car, like mileage, like your computer. Maybe you have a home office. You can write off a portion of that. If you have these business expenses, you can pay those before tax. That's a huge advantage. I took a course when I was completing my MBA at Virginia Tech by a former IRS auditor, and he shows this picture on the board of what looked like, garden supplies. He had a bucket, he had a hose, he had a spray nozzle on there, some other stuff. And he said, "What is this?" And people were like, "Oh, that's garden equipment. That's stuff for your house." And he said, "No, that is your supplies to clean your company vehicle." And everybody just kind of chuckled. But his point was you can be aggressive if you properly document your expenses. So if you go out to a meal with a business partner, you can deduct that to a degree. If you have a car and you use that for business expenses, you can deduct that to a degree. You want to ask what expenses are business expenses, what expenses are personal expenses, and then I would encourage you to say, how can I make these expenses business expenses? If that is appropriate, ask yourself what the rule is for that, and then see if that is in compliance with your personal situation. Now, the next level, if you're looking at W-2, 1099, would be an LLC or a partnership. You're going to have even more control. You're going to have even more planning opportunities. And if you take it a step further and file as an S corporation, there's even more advantages that the government has put in place to help you as an entrepreneur not only maximize the growth of your business, but also take advantage of certain areas of the tax code that not everybody has the ability to do. So these are some things that you can ask yourself and say, hey, can I structure my income differently? Can I structure my expenses differently? Because each level is going to give you increased flexibility, increased control, and more strategic options. And if you do this, you're going to be able to deduct legitimate business expenses. You're going to be able to optimize how your income is taxed. And you're going to be able to separate not only your risk out, but you're going to separate that from your personal situation, which means you create these opportunities for ultimately reinvestment. And that's what I want you to think about. Your structure should support your strategy, not be a limiter with respect to that. Now, I want to point one thing out here, depreciation. Depreciation is one of the biggest advantages that the government gives us. And this comes through real estate. It comes through other private investments. If you're invested in oil and gas, there's a lot of write-offs that you have with that. Business equipment through Section 179. Here's a great simple example. If I have a business, I can look at the Section 179 rules and I can buy a car, say an SUV that may be just a little bit bigger than the car I was looking at. Maybe it's about the same cost. Maybe it's even more. But because of the Section 179 rules, in 2026, you can deduct up to 100% of that Section 179 compliant vehicle. And that's just a simple example of how you can use the rules, read the rules, and see if that applies to your situation. Now, the nice thing with real estate is, whether you own it in your business or as an investor, is the IRS allows you to deduct a portion of the value each year. And that means you can potentially offset your income that you're earning with these non-cash expenses. Some people call it phantom depreciation or phantom losses that actually reduce your taxable income while you're still generating real cash flow. So, I'll tell you, banks don't like me because it doesn't look like I make a lot of money because of all our real estate investments. We have all this depreciation, but I make more money after tax than if I didn't use that. So it's a great advantage to have. It allows you to earn income, pay minimal in taxes, which means you can reinvest more of your capital. Now, as we talk about entity structures and proper structures in your business and investments, it's really important to talk about risk transfer. You want to protect what you build. As your income and assets grow, your risk is going to increase. If you have rental properties, you have to make sure that you're properly insured, so you don't get sued and lose that. You want to make sure that you have those properties in an LLC. And again, the government teaches you the rules for this. So if you don't, you need to get a tax strategist. You need to have an attorney that can properly structure these for you. And what this means is if you structure this properly and you have the proper insurance in place, you can transfer risk. And what that means is you move potential losses away from yourself or your business to an insurance company. And this includes liability insurance, umbrella policies. I used to sell these when I was with State Farm a couple decades ago, property insurance. I will say, if you're listening and you don't love insurance, I appreciate that. I'm one that has kind of come to love insurance. And I've done this because I've seen what happens when you don't have insurance. Helene hit Asheville about a year and a half ago, and I have friends that lost their homes, lost their business buildings because they didn't have, for instance, flood insurance. And I watched my mom die. I watched my sister die. I watched my stepfather, as I mentioned, go into assisted living without insurance. When you need insurance, no one ever says, I had too much insurance. But when you need to have insurance and you don't have it, it can be catastrophic when it comes to that. So you want to evaluate both your entity structures for asset protection and separation, but also you want to make sure you evaluate your insurance. And again, think of insurance not as a cost that's a sunk cost that you're not going to use. Think of it as a strategic tool. And this is the great thing and why we love life insurance. I was reading on X this morning, a financial advisor said, don't buy whole life insurance. It's a scam. Now, whole life insurance gets a bad rap because it can be really expensive. That's why in a lot of situations, it's better to buy term insurance. If you want to maximize your coverage and minimize the cost, nothing beats term insurance for that. But what if you structured life insurance differently? What if you structured it to not only protect your assets, but also to create liquidity, provide tax advantages, and most importantly, transfer your wealth efficiently? That's why we structure our insurance to minimize the cost, to maximize the cash value, and actually generate tax-free returns inside our policies. And we can use that cash value as collateral to borrow against in times of need, like when Helene hit, like when COVID hit, to loan to our businesses when our businesses need cash for different funding needs. We can use it to finance vehicles. And when you use it in this way, you create protection, you create liquidity, you create, as I mentioned, that those generational wealth transfer events that can occur. But you also create this giant flywheel. You create a family bank where you're actually capturing the interest that's going out every month. And a lot of us don't think about this. They just think like, hey, I borrow money from a bank for my house, for my cars, for college, and that's just the price of doing business. What if you could capture that interest that's coming in and actually be the bank and create this? It takes a little time and the proper structure to get set up, but once you do, you can actually have a family bank that spans generations, just like the Rockefellers did. They provide this capital, this liquidity to their family that creates opportunities to invest with that capital. We're going to use it to pay for our boys' college education if they decide to go to college. Instead of them paying that money to somebody else, that goes back into our family bank, creating a pool of capital for our family to invest in businesses, to create other wealth generating activities. So again, I want you to think about insurance. It's not just about defense, it's about creating certainty and providing yourself downside protection when it comes to that. I want to move on to qualified plans. So 401ks. I've talked about how 401ks are the worst vehicles for financial freedom. And what I mean by that is if you look at these qualified plans, the assumption is I'm going to work from 25 to 65. I'm going to retire. I'm going to make less money in retirement. I'm going to have less assets in retirement, and I'm going to have to pay less taxes. Now, I don't know about you, but if I look at the math, if I look at how the government's spending and the deficits we have, I think taxes are going up, not down. And if you're putting money in qualified plans, you are actually betting on the fact that you're going to pay less tax in the future. Now, you may say, I am, Chris. I'm not going to make much money in retirement. I'm going to lower my standard of living in retirement, and I'm not going to have to pay as much tax, and tax rates aren't going to increase. If you're willing to make that bet, then qualified plans may be a good fit. But these plans prioritize tax deferral and long-term accumulation. You can't get that money out before 59 and a half without penalties. You can't invest in alternative assets with these different plans. You can't use it for things like if you have a 529 plan for your kids, you have to use it for very specific things. And there's a lot of limitations when it comes to that, which is why we talk about strategies that are different outside of qualified plans that provide tax advantages, that provide flexibility, that provide liquidity and higher returns throughout our life and throughout our family's life as well. So as we look at this in total, I want you to take an integrated approach because wealth builders don't look at income, taxes, investments, and insurance all as disparate, separate things. They look at it holistically. They integrate everything into a plan, which allows them to reduce taxes, increase reinvestment, protect assets, and scale efficiently over time. And to do this, you don't have to do this all by yourself. You need the right team. You need a proactive CPA. You need the right insurance advisors who understand wealth strategy and are using these strategies themselves. You need the right legal professionals to structure your entities appropriately. And you need the right investment partners because you can try to do all this yourself, but if you create the right strategy, that's going to beat all the effort that you're going to put in all by yourself. You can use chrislarsen.ai as your 24/7 strategic advisor, and ask my virtual twin here, how you can explore entity options, evaluate your tax strategies. Now, we're not legal or tax professionals, so just use this to get some ideas and bounce some ideas off of there. And if you need experts, if you need a CPA, if you need an attorney to help you in your situation, just reach out to us. You have our contact information in the show notes, or you can email me at chris@nextlevelinCome.com. And you can keep more, you can structure smarter, and ultimately you can protect what you build. So let's summarize and go through your checklist at the end of this chapter. Review your current tax strategy, or maybe your lack of tax strategy. Evaluate your entity structure for your business, for your investments, for your real estate. Identify, looking at all these, opportunities for tax efficiency. Look at your insurance coverages. See, are they optimized for protection? Are they optimized to protect you and your family from those insidious, erosion of wealth that we talked about before? Is your life insurance set up to not only provide protection for your family if something happened to you, but is it there to create generational wealth? Or do you just have a term policy that's gonna run out? I had a tax advisor say, Chris, most of my clients, they don't need whole life insurance. They're fine with term, because they're going to self-insure after that. I said to him, that seems like a very selfish perspective. I said, if I have $10 million of permanent life insurance, that's $10 million of generational wealth that goes on to my heirs. And I'll never forget this when my wife and I sat down over 10 years ago, about 12 years ago now at this point, to set up our first estate plan. And the attorney, when he looked at our net worth, he had a number that was a couple $1 million more than what I thought it was. And I said, where did you get that number? And he said, will you have whole life insurance? You have permanent life insurance. That is part of your family's estate, even if you pass away. And it caused me to look at insurance in a whole different way. So are you considering that when you look at your family's plan? So again, use chrislarsen.ai to model your strategy. Reach out to us if you need some help finding the right advisors, and make sure you go to nextlevelinCome.com/financial freedom book to reserve your free copy of our new ebook.